Hi, I'm Dave Purdy, founder and CEO of Wealth Management Midwest. And I got to tell you, I'm extremely excited about today's video presentation. And I'll say this meeting today has actually been in the works for about a year and a half. And kind of the background on this is, and I'll introduce our guest in just a second, the background on this meeting was at Wealth Management Midwest, we're all about having perspective and thinking about things. And over a year ago, in early 2019, I thought to myself, we've got an election coming up in 2020, and it would be really fantastic to have really a top of the pyramid person, market strategist, come to Minnesota and do a client event. And it was scheduled for May and took over a year to get this special guest, as I'll say. And because of COVID, we actually had to cancel that whole thing. And in talking with our special guest, we said, well, let's just do a Zoom meeting in early October. And we've had a lot of volatility in the markets, and you've got the election and all these other things going on. So I think today's a great time to have this video. And I want to kick it off. I want to introduce Chad Olson. Chad is the president of Wealth Management Midwest. He's been here 26 years, really handles all the investments. And I'm going to let him introduce our special guest and kick it off.
Yes, hi. So I'm Chad Olson, president of Wealth Management Midwest. We are excited to have Ryan Detrick, chief market strategist for LPL Financial, join us today. Ryan is a widely sought after speaker for his expertise and viewpoint on the financial markets. He is frequently interviewed on CNBC, Fox Business, Bloomberg News, and is often quoted in the Wall Street Journal, USA Today, and Yahoo Finance. We have followed Ryan's market perspectives for years and really connect with his ability to put market data into a historical perspective that is easy to relate to. I have had the pleasure to meet Ryan at investment conferences, and you could not meet a nicer, more down-to-earth person. We are honored to bring his outlook and perspective to you. Ryan, thank you for joining us today.
Well, thank you, Chad, and thank you, Dave. I'll tell you what, every time I present, if you guys could just come with me and do what you just did, because you made me sound way better than I am, trust me. But I'm really happy. And Dave, weren't we doing a thing in the bowling alley? Were we doing something at the bowling alley in Minnesota? Wasn't that the plan? It sounded awesome. Like I was so excited. Oh well. It's we'll do it. Rain check. But this is a neat way, and this is a good example, I guess, of just kind of the world we're living in. It's been devastating what has happened this year to our economy and to so many people that have been impacted by COVID-19. At the same time, there are some positives, right? I mean, just the fact that people are using Zoom and using WebEx, and I don't have to get on planes anymore necessarily to talk. Although, believe me, I love the idea of getting out on the road and seeing people. But still, there are some positives. That's what I really want to focus on today, for the next 30 minutes or so, just kind of what we see here at LPL Research, whether it be the economy, the stock market, maybe a little bit on bonds, and obviously we'll talk some about the election as well, and just kind of put it all together. But you think about this year, fastest bear market in history, S&P down 34% in 6 weeks. Our economy was going pretty good. Fourth quarter, it slowed down. January and February, things were humming. Honestly, third week of February, things were looking really good. S&P made a new all-time high on February 21st. And then you can see here on the screen, we had a big drop, really big drop. And that's when the Economist came out with this cover that said closed. And that's what it felt like, right? The third week of March 23rd, the whole world felt like it was just crashing down. A lot of fear out there, rightfully so. Stock market pulling back. Bond market sniffed it out. If you think about the bond market, what it was doing back in February and early March, it was giving some warning signs. Stock market didn't really believe it until things got really bad with COVID in March. And then what happened when that cover came out from The Economist, it said closed. That was the lows. Okay. I traded options for about 11 years before I came on this side of the world, managing money, working with advisors, and I love it. But the one thing I really took away from when I was trading, more a trader's mind versus an investor's mind, when everyone's on one side of the boat, that's when you have opportunity. Okay. And now, sometimes you say, I like this or I like that. If people look at you a little funny, you might be on to something, because, what did Patton tell us, right? If everyone's thinking alike, nobody is thinking. And in late March, it sure felt like that, because there was so much bad news that was out there. Market had priced in a lot of that bad news. And then, some of the just terrible things that we thought were going to happen didn't happen. Now, some really bad things happened, but then we had this record bounce. And that's what you can see on the screen. For March, we had this big bounce. And then we're making, I guess let's see, the last new all-time high was September 2nd. September 2nd, we made a new all-time high. And check out the magazine cover that The Economist came out with around the middle of August. Free money. They literally had a machine spitting out money. I mean, you talk about a differing what they were talking about 6 months ago. And I'm not ripping The Economist, or maybe a little bit. But, they're trying to sell magazines. And that's kind of the feeling was, the stock market's up because of the Fed or because of central governments, keeping rates low and printing money. And that's what they're going with. But the other one, tech-fueled everything's awesome rally, looks unstoppable. All right, that was a Reuters cover. Or a Reuters story. When I saw that, I'm like, oh my goodness. Remember back in March when the market was just going to go nowhere but to zero, and then it didn't, came back. Then we were feeling the exact opposite thing in September after a 5-month win streak. All right. I know my next slide, I'll talk about the 5-month win streak, but spoiler alert, they tend to resolve higher a year later. So we had a little too much optimism. People went the other way. Sure enough, we had a very quick 10% correction in the S&P last month in September, the second half of September. The NASDAQ, which is clearly led, right? Technology's done awesome. We know the big cap tech names have done really well. Our opinion, some people say, hey, is this 2000 all over again? Because the tech is leading so much and tech's doing so well. We'd say no. These companies are making money. All right, you look at earnings growth. Technology was one of the few sectors that made money, is going to make money this year. Technology earnings are about 5% this year. I'm not saying 5% growth is great, but what I am saying is tech, in our view, justifies it. Yeah, it got stretched. It was too far. It was time for a pullback. But what's happened on that pullback? Right, the baton's getting passed around. It's not like tech's going down and the whole market's just crashing. We had that 10% correction in the S&P. We had that 15% correction in the NASDAQ, 25% correction in some of the bigger, well-known FANG stocks that you guys all know. So that was time. It was just stretched a little bit. But look what's happened under the surface. But small caps all of a sudden are starting to do really, really well. As the time we're recording this, the transportation, the transports are making all-time highs. All right. Copper has been extremely strong. Material group is doing very, very well. Industrials are doing well. Those cyclical value names. When you hear cyclical value, you've heard that on TV, you've turned it on. What it means are the things that are going to come back if the economy does a little bit better. So kind of how we see the world at LPL Research is we think this bull market's alive and well. Bull markets usually last 5 years. All right. This one just started. Okay. Economic cycles of growth last about 5 years also. We just had a 10-year economic cycle of growth. This recession is likely over in our view. Doesn't mean the economy is going to be great. We'll talk about the economy soon, but there is growth coming. So we still like, the technology communication services over here, but on the cyclical value side of things, your industrials, your materials, some of those can do pretty well if the economy does a little bit better. So it's really unique, but just how The Economist has really nailed, you could say, one of the major peaks, September 2nd, and absolutely nailed the lows back in March. So let's just take a big picture look. A lot of numbers on here, but here's what it's telling us. A year from now, stocks will probably be higher, and here's why. The S&P just had a 5-month win streak. It ended in September. Okay, stocks finally pulled back in September, and honestly, I think that's healthy. You kind of want pullbacks. Trees don't grow forever. You don't want the stock market to go up forever because you know what's going to happen. It's going to come back and really be painful when it does. So this consolidation that we've been having really since the end of August, in our opinion, is quite healthy. But here's on the screen, you can see here the returns after a 5-month win streak. A year later, S&P's higher 25 out of 26 times, up about 13% on average. Your average year gains like 8%. All right. So you've got stronger performance and quite likely a potentially higher equity market a year later. Why is that? Well, momentum begets momentum, right? What have we learned, right? Newton taught us an object in motion stays in motion unless something knocks it out of the way. Now, believe me, 2020, there's a lot of things that can knock it out of the way. And how about, oh man, Dave, how about Eddie Van Halen? Oh, gee, I'm sure you're a fan. I know you're a fan of Eddie. It's like I have too. I mean, just oh my goodness, 2020. It's like, are you kidding me? Taking Eddie from us? It's rough. Anyway, so I get sidetracked sometimes, but that hurt. So one of the positives again though is got to wave my arm over here because I've got a green screen behind me and the light doesn't see it, so my light starts going off. The truth is what we're seeing is really strong. Also, we just had a third quarter, right? We saw really good gains in the S&P 500 in the third quarter. Historically, stocks don't do so well in the third quarter. Okay, that's just kind of how it works. Fourth quarter is usually pretty strong, feel good time of the year. Stocks tend to do well late in the year. So what does it mean when you just had a good third quarter? Because stocks gained like 8% in the third quarter. Once again, I took a look at what happens in the fourth quarter after a strong third quarter, which normally isn't strong. The fourth quarter, guys, has been higher 11 out of 11 times since World War II with some stronger than normal performance. And I get all the concerns. We get it, right? All of the debt that's out there. We'll talk about the debt in a little bit. The concerns over COVID, something called the election with a very divided Washington, very divided country. There are some big concerns out there. What I'm seeing here, the stock market, though, is telling us that something's positive out there that could be higher prices. Again, look at the bond market, right? I talked about the bond market back in February. Keep this kind of simple. The 10-year yield went down a lot. The bond market was freaking out in February. The stock guys are looking around like, what's the bond market worried about? We're making new all-time highs. This is great. Well, the stock market was obviously wrong. We had March. We had that big correction. So the bond guys were, you could say, the smartest guys in the room, kind of warning the stock guys about stuff. Now, a lot of stock guys are getting kind of worried. We just had that big correction in September, bouncing back so far. But still, there's some reasons to be worried. What's the 10-year yield doing? 10-year yield is going up. 10-year yield's expanding. Copper, the industrial metal copper is making like 2-year highs. Transports, like I talked about, are making all-time highs literally like as we're speaking. Semiconductors, a big part of the global economy. Semiconductors is just tried and true group that continues to do well. Our opinion at LPL Research is the market's telling us something that maybe there's better times ahead and potentially continued higher equity prices. And that's kind of how we see things playing out here. Now, all isn't lost. And this one, it made more sense a couple of weeks ago, but I think it's important to remind people of this. We just had the fastest 10% correction in the history of the NASDAQ. Think about that. NASDAQ's been around, since the late 70s. It took 3 days to go from an all-time high to down 10%. That was really scary. I mean, that happened fast. Everything's going great. You're making all-time highs. And 3 days later, you're down like 10%. And a lot of those FANG stocks and the previous leaders were down a lot more than 10%. So a lot of people are probably in those because, hey, they've been doing great. And you look around and you're kind of worried, what's going on? Well, we took a look at it. That's what was shown on the screen. 6 months to 12 months later, after the fastest corrections ever, and by definition of correction, I'm calling it a 10% correction. You see the numbers. Up 23% on average 6 months later, up even more a year later. Now, we're not saying that's going to be the case necessarily, but, you can see a year later, look at some of those numbers, wildly strong. Now, there's always the caveat, down almost 60%, after the tech bubble burst in early 2000. But again, like I said, we don't see the tech bubble bursting. I mean, we see valuations that are a little stretched, but when you consider the fact that inflation and rates are low, you tend to have a little bit higher valuations. That's just kind of how it works. And I saw some interesting stats. There's going to be more IPOs this year than there were in 2000. There's going to be like $100 billion worth of IPOs. And you hear anything last time 2000, we all started having major flashbacks to, the tech bubble when tech pulled back like 90% and the stock market got cut in half. So we're not minimizing that. But again, a lot of these companies, a lot of these IPOs, you know what they're doing? Making money. They have a plan to actually make money, which if you remember around 20 years ago, like pets.com and some of those, I mean, they weren't trying to make money. They were just trying to get their name on CNBC and have the ring the bell at NASDAQ and everything goes straight up. I mean, so it is, Sir John Templeton said, this time is different. 4 most dangerous words to investing. And I believe that. But as always, it's never exactly perfect. And this time is different, okay? Because these companies are actually making money and technology is still making money and growth stocks are still making money. So there's some big picture things there. Let's talk about a little bit about the recovery and the economy. So the economy, again, was really humming. And then we stopped our economy. Our economy hit a tree is kind of how we put it. This is not your average recession. Normally in recessions, you have a policy mistake. What is that? Well, the Fed sometimes just hikes rates too much, right? To stave off inflation and maybe just honestly to cause it. Maybe they won't come out and say it. Maybe to cause a recession because there are some positives to recessions. There's a lot of negatives, and especially this recent one. But there are, you go back and look at when Dow company, like the 30 companies in the Dow, when most of them were created, take a wild guess. They were created during recessions, okay? That's when the true leadership and what we've seen just with a lot of our LPL advisors and with Dave and with Chad, it's the ones that are able to adapt. The fact that we're doing this right now and you're able to see it, this is how we adapted. Yeah, we're not hanging out in the bowling alley having fun, me doing something like this, but we are doing this. All right, it's about can you adapt in a tough time. And the true winners in this world have been able to, and the people that have struggled haven't been. Now, How do you adapt if you're an airline? I don't know the answer to that. Okay. How do you adapt? My father-in-law owns a restaurant in Cincinnati, really popular, wildly popular restaurant. Well, Cincinnati, Ohio, I should say. Well, there's rules. He can't open his restaurant back up. Okay. He can seat people outside, but he can't. And it's getting cold. It's Ohio. It's getting cold. I mean, I'm down here in Charlotte, a little bit warmer. It's getting cold. So he's wondering, how am I going to make this work? And even then, are people really going to want to eat inside, sitting next to some people? Yeah, you keep them apart and do all you can. But there's certain industries that are just impacted by this so much. 28,000 people at Disney just lost their job. 9,000 people at Shell just lost their job. 4,000 at Allstate just lost their job. 1% of the workforce at Goldman Sachs just lost their job. Oh, and by the way, Cinemark, one of the largest movie theaters with 536 movie theaters in the United States, they just closed them all, and they just said 25,000 people just lost their job. I mean, it is devastating what's still happening in our economy. Certain parts of the economy are doing great. Honestly, financial services industry, what I'm doing with LPL, we're doing pretty good in this situation. So I'm not naive to that. I'm fortunate, believe me, extremely fortunate, because people realize they need investment advice, and that's why you've got Dave and Chad absolutely out there to help you every step of the way, and the LPL research team there to help as well if you need it. But it is so tough because this economy is truly going two ways. We call it a K-shaped recovery, and it's a little geeky. There's V-shaped recovery, down, up, W-shaped, down, up, down, up. K-shape, just think about a K. What's a K do? Part of the K goes up, part of the K goes down. This was not our base case 4 or 5 months ago, but it is now. We have the haves and have-nots in this economy, and that's the sad, sad truth. And that's why this next fiscal plan, which, I don't know, 2 days ago, President Trump said it's off, and now it's back on. I mean, some Washington drama there. It is so important for this next fiscal plan to help those people that have been so impacted. It's not their fault that they lost their jobs, right? I mean, it's a 100-year pandemic happened. I mean, but we need to help them, and we think there will be another stimulus plan. Will it be this big stimulus plan? We might have to wait till after the election. Let's be honest. Can we even get people $1,200 checks in time before the election? I don't know. I mean, it's tough to get that stuff all squared up, but there is more coming. It might not, unfortunately, we're caught up in an election, and that's just kind of what happens. But look at the screen. This is jobs. How long it takes jobs to come back. Well, the recent real big down and back up a little bit, the blue one, that's now, right? 22 million jobs were lost in 2 months back in the spring. We've made up about half of those, about 11 million. The truth is it's going to take years for jobs to fully come back, for the employment picture to get back to where it was. The green that goes about 6 years there, you can see it takes a long time. That's the most recent recession. That's the financial crisis. It took 6 years for jobs to come back. The previous longs before that, take a guess, the tech bubble, accounting scandal, early 2000s recession. So the last 2 recessions were the longest for jobs to come back. Why? I think we're kind of like a cruise ship. Here's what I mean by that. We're a developed country. It takes us a long time to get moving, right? One of our big themes we're talking about now at LP Research is restart the engine. If you got an engine that's banged up and beat up, you're not just going to turn it on right away. You got to fix it. You're going to let it rev up a little bit. You're not just going to go out on the highway and just blast it, right? It's going to take a while to get that engine back. And that's where we are right now. And history told us it's going to take, or history tells us it's going to take a while to get the jobs back. And that's just the truth. They're coming back. There are parts of the economy. And my goodness, manufacturing has expanded 4 months in a row. Industrial production, 4 months in a row. Some of these regional manufacturings that we're seeing, like the Philly Fed and New York Empire State, and there's some other ones, it doesn't matter. They're all like 2-year highs, all right? There are parts of this economy clearly coming back. Services is the one that's struggling. Are people really going to take cruises? Are people really going to eat in restaurants? Are people really going to go on airlines? Stay in a hotel. I mean, slowly, we're getting there. But it's going to take a while. But manufacturing's coming back a little faster because you can automate manufacturing. It's a little bit easier manufacturing to stand 6 feet away from somebody than you are at a busy bar. I mean, that's just the truth. But still, it shows how divided our country is with kind of how this recovery has been. So which is it? What I mean by that is this bull market that I'm calling it a bull market. We just gained 60% in like 5.5 months. We're calling that a new bull market. It doesn't mean it has to last 10 years like the last one. In fact, it probably won't. It's safe to say. But this is a new bull market. And it was the best start to a bull market ever, as you can see on the screen. That's the first year of all the bull markets we've seen since 1950, or World War II, I'm sorry. Now, it's as right about 6 months or so, it's kind of come back a little bit, and the lows off the start of the 2009 bull market was better. But what I really want to point out here, the 2 previous best starts to a bull market ever were 82 and 2009. Those might ring a bell. Those are some pretty good cycles, some pretty good growth. But the rest of the year, just the next 6 months, you know what those 2 did? Hung tough and saw continued gains. So again, Mark Twain said history doesn't repeat, but it rhymes. We don't know exactly if this is going to be the case again. But when we've had good starts to bull markets before, stocks have held in there and done well going forward with these big gains. It's something to be very aware of. What else to be aware of the calendar? It is October, and October historically an election year is the weakest month of the year. And you have, you show right here. So before an election, you tend to get a little bit of weakness. That's just how markets work. A little bit of skittishness ahead of the election. We're in October. October gets this bad rap, right? 29, 87, 2008. October also has had some huge gains. 2011, for instance, in October. Last 10 years, October is the second best month of the year. You guys know the best month the last 10 years? February. Little old February, shortest month of the year. But the election year, October is the worst month. So it makes sense to have some volatility. And boy, are we seeing volatility. For the last 9 days, the S&P gained 1.5%. Some of those other days, it was down a lot. So October is living up to its name of volatility. And you guys could have 10 people and ask them 10 times, why is October so volatile? There's a lot of reasons. Mine, I think a lot of hedge funds and institutions close their fiscal year at the end of September. So they open up a new year in October, and maybe then they kind of do some more things. They were a little leery in September. Maybe they just get more volatile in October. And that's just a theory, trust me. But the reality is what we're trying to tell people is October is volatile, especially in election year. And we're there, right? So just something to be aware of. And I want to point it out now before I get too much further, because I talk about the economy coming back, just all the debt that we have. There is no question when you look at the U.S. debt, there is an enormous amount, right? $25 trillion or something along those lines. And we're talking about another couple $1 trillion for the next fiscal plan. I just talked about the need for the next fiscal plan. So there's more debt. There is no doubt in my mind that I can't say no doubt in my mind because that's almost too guaranteeing, and compliance doesn't like that. There's a very good chance in my mind the 10-year economic cycle of growth that we had from, we'll call it 2009 to obviously February of 2020. We, in the best years, barely printed 3% GDP. All right. We had an expansion, but it really wasn't this rip-roaring expansion. Now, we're a more developed country. I talked about that. We're not an emerging market anymore. We're a developed country. But still, I think a big reason for that was all the debt that we had. We created a lot of debt to get out of the financial crisis. And it helped for 10 years. We had growth, but we didn't have rip-roaring growth. So it's kind of unique to think because all that debt might have held us back from reaching our true potential. At the same time, it might have helped expand the cycle to last longer because you didn't have the booms and busts. I mean, what you see historically at peaks is too much leverage. We didn't have too much leverage this time, right? I mean, your average consumer was in really good shape. And believe me, there's not a lot of positives. One of the positives that we just had with this recession, credit card debt's gone down a lot, right? People got extra money from the government. They're hunkering down. Maybe they dipped into their savings. That's not good. But nonetheless, credit card debt's really come down. So that's why as this economy kind of opens back up next year, we get a vaccine and get more positive therapeutics. That can be a good thing. But back to debt. What we saw in March, stocks got killed, bonds got killed, gold got killed. That's the truth. If you were in any of them, you were calling up Dave, you're calling up Chad, saying, what's going on here? I thought my bonds were supposed to protect me. Well, it was a true, once a generation storm when everything was getting sold. Now, fortunately, they've all come back nicely, right? I mean, for the most part. But you know what went up in March? The U.S. dollar. The U.S. dollar was strong in March. So what did that tell us and tell the rest of the world? We have the world's reserve currency, whether people like it or not. We say it's the cleanest shirt in the dirty laundry. It's not the dollar's that strong, but it's still stronger than everybody else when the you-know-what hits the fan. They flock to the dollar. And that was a harsh reminder for us that, you know what? We can leverage debt here. We can use debt because people are still going to come buy our stuff. They're still going to buy our dollars, still going to trust us. In 1972, the U.S. dollar was synced to gold. John Connally was in a room, this is the legend has it, in a room full of bankers. And that's when the U.S., under the direction of Nixon, cut the U.S. dollar from gold. They said, no more. They're not linked anymore. That upset a lot of presidents, upset a lot of world bankers, upset a lot of economists. John Connally in the room full of bankers said, you know what? It's our currency, but it's your problem. That, guys, is the unfortunate truth to how we view debt, I think, ever since then. We continue to use debt to get us out of problems. I'm not saying I agree with it. In fact, I don't really agree with it. But that's just kind of one place Washington, whether you're on the left or right, actually does agree is using more debt. I mean, President Trump is one of the more liberal presidents we've ever had if you look at his view on kind of how to use debt to help grow. So that's a unique way to look at it there. But one last thing on debt, and then I'll get moving. If you look at how much our country pays on interest relative to its debt, here's something nobody talks about. And I call this denominator blindness. People just talk about the numerator, that big old shiny number on top. They don't talk about the other stuff. And here's what I mean. We have more debt now than we've ever had if you just look at the nominal number of the nominal debt. A lot of debt, not minimizing it. But interest rates are low. Inflation is low. What we pay on our debt now, at least as of last year, and I know we've added more debt this year, we don't have the official numbers. As of last year, even with a lot of debt last year, it was less on interest than we were paying 5 and 6 years ago because interest rates are low. So if interest rates are low, maybe you should have a little more debt. You're not going to pay as much on it. So just kind of an important concept there that I think sometimes gets lost in all the minutia of all the big numbers that people throw around. But still, I'm not a fan of using big debt. That's just my personal opinion and probably LPL research also, but we kind of have to in the situation that we're in. But with interest rates low, that is one positive reason to use a little bit more debt here. So let's get moving here. We just had one of the best 100-day rallies in the history of the stock market. I'm showing it here, up 50%, 50 days off the lows. Take another guess what happens 6 and 12 months later. Continued strong performance. Most of those dates, if you look at the screen here, took place in the middle of pretty good sized bull markets. And we've been saying this at LPL Research back in April, May, and June. What I've been saying time and time again is the bounce that we saw then was not a bear market bounce, not the end of a bull market. And as uncomfortable as it sounded at the time, it was the start of a new bull market. That much strength off of the lows that we saw in September is, again, historically what you tend to see at the start of bull markets. And I know it sounds crazy when you look at the headlines, but at the same time, what is the market telling us? A strong third quarter, small caps are now leading, the transport's breaking out, semiconductors keep leading. I mean, there are some things, the stock market, the bond market not panicking. I mean, last Friday, right, when the news came out on President Trump, as scary as that was for the stock market, big time sell-off. I remember coming in about 8:30, futures getting drilled, stock market getting killed last Friday. And then I looked at the 10-year yield. 10-year yield was down like 2 basis points. That's 0.02%. I'm like, really? The bond market's not worried at all. Apparently the bond market doesn't like President Trump. I don't know. But nonetheless, it's like, it's funny. Not funny. It's not funny. It's unique at how the bond market didn't worry about that. Boy, the stock guy sure got worried. I was worried. I'm looking around like, oh my goodness, what's going on here? And then what happened? Friday, market started the rally. Okay. Market started to bounce back. The bond market once again they freaked out in February. Bond market freaked out in a big way in February. And then look what happened. They aren't freaking out now. Bond market's actually, the 10-year yield's actually been impressive the last couple of months. A lot of people are thinking, that could be a sign of a potentially better economy next year. And again, the bond market is still saying that. So let's not ignore what our friends in the bond market are saying. And you know what? I skipped Jack Bogle. I love Jack Bogle. Jack said, I spend about half my time wondering why I have so much in stocks and about half wondering why I have so little. We lost Jack a few years ago, but I've read a lot of his books. And that quote there, boy, oh boy, that sums up 2020, right? You're calling Chad and you're calling Dave when, you got too much in stocks back in March. And then, well, now stocks are back up. Why don't I have more? It's a delicate line, but Jack's one of the smartest guys ever. And he's saying that. So believe me, if you're kind of confused, you're not the only one. But again, what I hope I'm laying out here is we do think that this bull market that has started potentially has a lot of life left and a better economy is coming, hopefully next year, next 12 to 18 months. Bear market recoveries usually take a while. I mean, that makes sense, right? This one took 5 months. It took 5 months to make up the 34% loss. It's one of the fastest bounce backs ever. There's different reasons for that. And one of them is clearly the Fed. I mean, the Fed on March 23rd, which if you remember that date, was the lows of the 34% correction. The Fed said, we're going to do everything we can. The Fed, let's call it the Fed bazooka, call it the Fed, Fed bazooka, kitchen sink. The Fed did a lot. The Fed, all over the TV. Fed chairperson Powell's been on CNBC. No, not CNBC. He's been on 60 Minutes like 3 times the past 2 years. No Fed chairperson's ever done that. The Fed is trying to do 2 things: confidence and liquidity. That's what the Fed's doing. For 10 years, from 2010 to 2020, interest rates were low. The Fed was a backstop. The Fed was there. What was the playbook then? Stocks did well. Economy, not as well as you'd hope, but stocks did well. The Fed is still there. There's the old saying, don't fight the Fed. And the truth of the matter is, we kind of believe that. Don't fight the Fed. The Fed is buying up junk bonds. The Fed is buying up corporate bonds. The Fed is buying up municipalities. I mean, the Fed is doing a lot of things that a lot of true traditionalists can't stand. I mean, the Fed's been around since 1913. Actually, the Fed, silly trivia stat for you. The Fed was founded on Jekyll Island in Georgia, and that's not too far from where we are. We went down to Florida about 1.5 years ago, and we had to stop halfway and say, I want to stop on Jekyll Island just to see where the Fed was. It's a pretty neat little island. So anyway, if you're ever traveling down, I think it's 95, the highway that's right along the coast there in Atlanta, in Georgia, check out Jekyll Island, where the Fed was born in 1913. Anyway, so the Fed is still there, and the Fed is a backstop, so it's not something we would ignore. The Fed minutes came out yesterday. They didn't say anything new. Fed chairperson Powell said low rates are here to stay. The Fed is a backstop. But you know what? Congress, the ball's in your court. You guys in Washington need to get your act together because we've done a lot on monetary stimulus. Monetary stimulus is just the Fed. Now we need some fiscal stimulus. And that's, again, the help, the states and the help the municipalities that have been so impacted by what's happening. And then the thousands and thousands of people I just mentioned that have literally lost their jobs in the past couple of weeks, along with, I think I saw 840,000 people filed for initial jobless claims this morning. It was a busy morning, but still, that's a much higher number than we would hope this stage. It's a stubbornly high number. To put context around it, at the peak of the financial crisis, like 660,000 people filed for initial claims, jobless claims. We hit 840 just last week. So again, that is just a harsh reminder of how tough this economy is going to be, or this economic recovery is going to be. We do think the recession's over, but it's still a very tough situation. This is earnings. I kind of hinted this a few times. The yellow is S&P 500 technology earnings. The blue is the rest of S&P 500. Literally, as we speak, the S&P 500 earnings have been cut significantly. We know that this year is going to be down like 25%, give or take. Okay, a big recession. We know that. Technology earnings are actually higher. I mean, it's amazing. In the middle of a 100-year pandemic, technology earnings actually increased. And again, they were some of the most adaptive, right? I talked about you need to adapt in this world, not just financial services world, but any world. It's the Wayne Gretzky quote. You got to talk about Wayne Gretzky quote. Everybody's got to use it in a presentation. Skate to where the puck is going to be, not to where the puck is. I mean, that is the truth of anyone's business. And technology's done it better than just about any other group. We've seen that. So yes, technology had a big run. Yes, technology was overstretched. It needed to come back, and it is. Maybe it's got a little more of a comeback in it. Pullback, wrong word. Maybe a little more of a pullback is what I meant to say. But going out 12 to 18 months, we still side with technology because the earnings are there. Let's talk about earnings globally. One of the few places we can truly, most people agree on, is earnings next year are going to be impressive. What we're showing here is United States, developed international, and emerging markets. All right. We're seeing some significant earnings growth next year in 2021. And that's what the stock market is sniffing out. That's why the stock market, when people are losing their jobs and everything looked terrible. Remember the headlines in April? Hopefully you don't. They were just terrible headlines. Yet the S&P 500, that's probably one of the worst headlines our country's ever seen outside of a war. Okay. I mean, the terrible headlines in April. The S&P 500 gained 12%, one of the greatest monthly gains in the history of the S&P 500, in the midst of all that terrible, terrible news we were hearing about. It's, again, the stock market, here's the truth. The stock market doesn't care about our feelings. The stock market's proven that time and time again. What the stock market cares about is what the future is going to tell us. Skate to where the puck is, not to where the puck, or skate to where the puck is going to be, not to where the puck is. That's why the stock market is skating to a better economic future based on earnings. And that's what that chart, we think, shows. A couple more here. We'll talk about the election for a couple minutes here, then we'll wrap it up. Our base case at LPL Research is we think this election is a little bit closer to what some of the polls say, first off, and I'll say why in a second. But we think, we're likely still going to have a split Congress when all is said and done. We think Democrats will keep the House, Republicans will keep the Senate. And historically speaking, when you have a split Congress, that's, for investors, that's music to our ears. As you can see on the screen, split Congress, S&P is up 17% on average. We have a split Congress this year. When stocks are down 34%, I was like, oh, throw that out the window. Now, clearly, they've come back. We didn't come back simply because of split Congress. We get it. But the last 10 times the Congress was split, the S&P was higher that year, the last 10 times. This year could be the 11th. So if we have, everyone votes for who you want to vote for, and hopefully who you want wins. But at the end of the day, if Congress remains split, that might be actually the most beneficial thing for an investment. And here's the truth. Why is that good? Well, maybe the best Washington is one that can't get anything done, right? Too much power one way or the other could potentially sway the pendulum, and that's what our forefathers didn't want. And that could be something to think about. At the same time, we've done, and I might have a slide of this in a little bit, but I'll say it now. We've looked, blue wave is obviously something we've heard a lot about, and the odds of that are much higher. There's no question about it. Still not our base case, but it could happen. Blue, we haven't seen stocks down. We have a Democratic president with both chambers of House Democratic since 1977. Like the last 5 or 6 times, stocks have been up. When we had the red wave 4 years ago, when President Trump won, obviously surprising most people, and Republicans took the House and the Senate in 2016, you know what happened after that? The S&P 500 went up 15 months in a row. I'll say that again. After the red wave, that's kind of hard to say, red wave 15 months in a row, stocks went up. So you're going to hear a lot about this and that. I'm actually going to talk about some of it. What might happen if so-and-so wins? Here's the truth. If you're not in a recession, stocks usually do pretty good. It's so difficult to say, but one thing I really want to stress at LPL Research is to differentiate between your beliefs from the election and your investment beliefs. A lot of people didn't like President Obama. They missed out on record gains for 8 years. A lot of people don't like President Trump. They missed out on nearly 150 new S&P 500 all-time highs his 4 years. And who knows, we might have another S&P 500 new high quite soon, the way things are looking, the way things are quickly improving here. So just separate things. But at the end of the day, a split Congress is pretty positive. Can the economy predict the next president? Maybe. You look back in history, guys, there have been 4 recessions since the Great Depression. The incumbent president lost every single time. If there was a recession 2 years before the election. If you don't have a recession, the incumbent president tends to win every single time. It's not that complicated, right? What did Carville say in 92? It's the economy, stupid. How the economy is doing really matters when people go vote. You'd have to say this favors Joe Biden right here. But at the same time, look at the one that didn't work. 24, Coolidge. We had a recession a couple years before the election. He still won his reelection. Why? The roaring 20s. The economy really was getting going when people went to vote in 24. Fast forward to right now, and I know we just said a lot of people lost their jobs. There are other parts of this economy that are coming back. We might have a 35% GDP print a couple days before the election. We might have one of the best third quarters you've ever seen. Now, it's coming off of one of the worst second quarters you've ever seen. So you're playing with some games and some numbers there. But there are parts of the economy that really have come back. So, this one isn't as clear cut in our opinion. But another interesting one, maybe I'll show this one first, is the stock market. The stock market actually is favoring President Trump in our view. Historically speaking, if stocks are up 3 months before the election, that means the incumbent party wins. If stocks are down before the election, the incumbent party loses. It's been right 20 out of 23 times. Our stocks are up 3 or 4% or so since you got to start this clock on August 3rd. So S&P's up 3 or 4% since then. And why is this? Well, maybe it's as simple as, the stock market sniffing out new leadership, and it just doesn't like uncertainty, right? So it sells off a little bit. Think about 2016. Everybody thought Hillary Clinton was going to win. I mean, we were looking at some polls in and now. I mean, it was like 90%. Most people expected Hillary Clinton to win, including LPL Research. Not like we had a different opinion. We saw the same polls as everybody else. She didn't win, though, obviously. But you know who didn't believe it? The stock market. The Dow was down 9 days in a row directly ahead of the election. Go look it up. The Dow was down 9 straight days ahead of the election. Not by a lot, but it was a lot of, little 1,000 cuts, I guess you could say. What also happened? Copper, the industrial metal of copper, a President Trump play on infrastructure, which, by the way, we haven't even had infrastructure yet. But nonetheless, we think we're going to get it more likely if the Democrats win, but we probably get an infrastructure plan if the Republicans win, just won't be as large. Copper was up an all-time record 14 days directly ahead of the election. A President Trump play. So what copper would tell us, what the stock market was telling us, you know what? It might not be so obvious that Hillary Clinton's going to win here. A lot of people ignored it. In fact, I did until after the fact, and I go back and realize these things. So just kind of, these are things we're talking about a lot at LPL Research, looking at for little clues here. And copper has been strong recently. So, if copper is strong and stocks are strong, we do think that favors President Trump, that maybe the election is going to be a little closer than most people think. And here's a chart that shows it, breaks it down by election year. If the stocks are up, if the blue is what happens if the incumbent party wins. And then the orange is what happens if the opposition party wins. Well, you can see we're in the sweet spot. If weakness happens, that probably means President Trump's going to win. If we see strength, it might mean President Trump is going to win. If it's strength versus if it's down, he'll lose. So we're paying attention to this stuff. It's kind of unique. I mean, I will say a lot of people are talking about this stuff now, including me. I'm sharing it a lot, so other people have swiped it, I guess you could say. So maybe when everyone starts talking about it, it's already priced in, but I still think it's worth paying attention to. The U.S. dollar, I guess, looks like my last chart here. The U.S. We'll finish up with the U.S. dollar. U.S. dollar, again, I talked about it already. When the hit the fan, the U.S. dollar was strong because people bought it. U.S. dollar is kind of a good example of you buy it up when things get troublesome. And we've seen that as well historically. When the U.S. dollar is stronger, you tend to see, the incumbent party is going to lose. When the U.S. dollar is down or weak, that means things are normal, things are more bullish. then that's usually good for the president. So right now, US dollar is actually a little bit lower than it was on August 3rd. Again, this one is kind of in the camp of potentially President Trump, again, suggesting in our view, this election is a little bit closer than most people think. So how the dollar is doing, how stocks are doing, how the 10-year yield is doing, how the economy is doing, all these things kind of play into this very, very heated, obviously, election that we're going to have very, very soon. So guys, I don't know how long I went for. Hopefully I went about the time you wanted me to. I probably went too long. I never shut up, but hopefully that was some good stuff. And I know you got some Q&A, and hopefully I didn't answer all of them during my little rant here, but let's do some Q&A.
Well, Ryan, thank you so much for your perspective and the slides. I think you did a great job of putting into perspective kind of where we see things right now. We do have a couple questions, as we mentioned before. Wealth Management Midwest, we tend to be longer term investors. Yep. We encourage our clients to ignore the day-to-day headlines and pay most attention to the general direction of the economy and long-term history of the markets. That being said, we're all human, and at times it's hard to ignore the daily news. Do you have any perspective for long-term investors to help weather this type of near-term volatility with the election and the news of the pandemic coming out?
Well, yeah, I mean, we're all human. I mean, you said it best. I mean, I do this, and I could tell you this much. If you buy any given day and wait 10 years, you're usually higher like 95% of the time on the S&P 500. You buy any given day and wait 20 years on a total return basis, you're higher like every time, okay? The stock market is the only place that I know of, maybe you guys know of a different one, but it's the only one I know of, when things go on sale, yet everybody runs out of the store screaming. And it's so difficult to do, especially, and people say, Ryan, why did we just have the fastest bear market ever? And you're like, well, that's a tough question. Like, why did we just have the fastest bear market ever? I think it's right here. These phones, right? There's so much information. It's information overload, whether it be to the upside or the downside. You can believe whatever you want to believe, find if people that agree with you, people disagree with you. I mean, they're wonderful, wonderful things, these phones, the way we're connected. But at the same time, there's some negatives. And I think, the way we're all hardwired, we can make mistakes. I mean, we make mistakes. Remember the movie Lawrence of Arabia? And the one guy, there's a candle, right? And the one big strong guy takes his fingers and goes like that and puts out the candle. And the other guy's like, I want to try that. He gets ready to put the candle out with his fingers, and he grabs it. And what's he do? He screams and yells like, oh my God, that hurt so much. He looks at me and goes, how'd you do that? And the guy who grabbed it and didn't react, all he said was, you just got to know it's going to hurt. And the truth of the matter is you have to know investing is going to hurt. There are going to be times you're going to call up Dave, you're going to call up Chad and say, I can't take it, guys. This is crazy. This is going down. I just saw that guy on CNN. I just saw that guy on Fox. I just saw that guy on Bloomberg, wherever. And he told me we're all going down. There's too much debt. It's all going to end. Harry Dent's saying this world's going to end forever now. But it's like, you got to remember it's going to hurt. But when things go on sale, there's always a lot. The sun's going to come up tomorrow. There's always going to be better times. And believe me, it's been devastating what's happened this year, losing as many of our country people as we have. And so many people have been impacted by this. This one does feel a little bit different. But still, from an investments point of view, we're going to have another bear market. And when you're down, you're going to call Dave and Chad and be worried about what's going on. Just remember, though, that markets tend to come back. They're forward-looking. They discount the bad news. They're looking out the front. They're not looking at the back of the rearview mirror anymore. They're looking out the front of the car. And you just have to believe in our country. And that's harder said than done. I fully get it, but that's just the best advice I can give is just the resolve of our country. You have to believe we're going to continue to come back, and we will do it again, and we are doing it right now.
That's well put, Ryan. The second question is, I was recently visiting with a client of ours, Ken, and he had a question I think is on the mind of a lot of different investors. We have nearly 4 years of information on President Trump and the areas of the market that appear to benefit from his policies. What sectors and asset classes does LPL research and you think would be most likely to benefit from a Joe Biden victory in November?
Yeah, I mean, well, for starters, we think cyclicals could do a little bit better because he's going to bring a lot of spending. See, people worry about Joe Biden because potentially if you get the blue wave, blue sweep, whatever you want to call it, taxes go from 21 to 28% on the corporate side, more regulation as well. Could that stamp out the economy? We don't think so, okay? There are some pluses here as well. He's going to do a lot of spending. If there's one thing the stock market likes, it's spending, all right? Whether it be infrastructure spending, green energy spending, there are some positives. Also, by the way, we've got a lot of tariffs with China, and tariffs are a very touchy subject But the truth is, Joe Biden is likely going to remove a lot of those tariffs. You remove those tariffs, you open up potentially a lot more spending globally and potentially help S&P 500 earnings. So yeah, there's higher taxes you'd think on the surface aren't great, but there are some other real positives that could happen under Joe Biden. So we think the cyclical names, historically speaking, cyclicals done better under Democrat. Also, cyclicals do better when the incumbent party loses. Well, that could play out. Healthcare also is a touchy situation, but we think healthcare, we think biotech. I don't care who the president is. I mean, biotech is a group with all the things that we're breaking out. My mom has breast cancer. She had breast cancer for 4 years. She got diagnosed 4 years ago. She's been fighting it every month, getting her pills and taking her medicine and everything. Some lumps came back. You know what they did? They cut them out, sent them. This is like 2 months ago. Cut the tumor out a little small piece, sent it to Boston. They ran this thing through, and I don't know what biotech it was. I probably should find out. 189 different breast cancers. This ran it through. They determined exactly what it was, and they determined exactly you need to take this medicine, this medicine, this medicine. I mean, that wasn't like that 4 years ago when all this stuff started. The developments that we are seeing in healthcare and biotech, I think those are some groups we really do like. Now, the other one is technology. You just read what some of the Democrats said in the House just yesterday. They're antitrust against Google and Apple and too much power for the technology names. That might be one area to pay a little more attention to. I said we like technology, a lot of good earnings growth, but there could be a little more of a headwind potentially for technology. But let's be very honest. When President Trump won, what'd they tell us? Coal and steel and financials would do well, and technology wouldn't do well. He's going to go after them. The exact opposite happened. So it's so important to remember, we all kind of think we have a clue what's going to happen here. But at the end of the day, if the economy's strong, we still think that that's kind of the play. And obviously, with Joe Biden, I guess we'd say the industrials, your materials, your cyclical value names, those might do a little bit better under him, at least initially.
Sure. Well, Ryan, I lost my mom to breast cancer in 2004. So our thoughts and prayers are with her and with your entire family. Lastly, if the results of the presidential election are delayed by weeks, not just days, our perspective is that we would see increased volatility in the short term. But longer term, we don't think the overall damage would be all that severe and would be pretty short-lived. What are your thoughts on that?
Yeah, we agree. We actually just wrote about this in our weekly market commentary. Go to lpl.com and see. We talked about the chaos, right? What if there's chaos? What if we wake up on November 4th, 5th, 6th, 7th, and we don't have a winner, and you have a contested election and all those things? Well, again, let's go back in history, right? We've only had 2 contested elections, at least in like recent history. 1960, which didn't last very long, and then 2000. We all remember, for the most part, 2000. S&P pulled back about 10% from the election until from the max pullback until I think it was December 12th when they finally declared George Bush #2 the winner of that election in 2000. But we saw about a 10% correction. Market didn't like it. Now, also, we were in a recession then. Right. So, you got to remember, during a recession, stocks don't tend to do as well. But we're in the camp also that there will absolutely, in all likelihood, be a market that doesn't like uncertainty, and it could sell off on news of no true winner, at least initially. Sure. Yeah, makes sense. But like I said, we're gonna have a winner eventually, and then things can get going. And the bottom line here, 2020, I showed that slide with the earnings growth. There's always a chance of a recession. I mean, we didn't think there'd be a recession this year. In fact, there probably wouldn't have been if COVID didn't happen. That's the truth. So if something else bad happens, we could have a recession next year. But the chances of a recession next year with the growth and opening up the economy, beating COVID, getting vaccines, getting positive therapeutics. Look what Bill Gates just said yesterday, right? Bill Gates kind of sparked the rally yesterday. No one gave him any credit for it. He said, the stuff that President Trump just got, and I get it, he got it because he's the president. But Bill Gates was saying, hopefully in another month or two, anyone, grandparents or parents that get sick from this thing that are older, of high risk, hopefully they can get the exact same stuff that President Trump just got, whether it be the Regeneron drug, the Gilead drug, oxygen and steroids. President Trump's probably the first person in the world to get all 4 of those things. What he said, he felt pretty bad Friday, and he got out a couple days later. Let's hope that everyone can get what he just got. And that's what Bill Gates just said yesterday. And that's another reason to be optimistic into the future that we are going to beat this thing. We beat scary things before, and we're going to beat this thing too. It's just, we had a lot of pain to get there, but there's some positives there.
All right. Well, sounds great. Well, Ryan, before we wrap this up, do you have any final thoughts that you'd like to share with us?
Oh, I mean, I guess I kind of ran on my rant about how, stocks are going to scare you when they pull back, but you guys are in very, very good hands, with Dave and Chad. I'm honored to have been here. Hopefully we get to do it in person sometime, but, I get to do a lot of these, and I can tell you this. A lot of advisors, when the market was pulling back, they kind of hid themselves. They kind of weren't out there, and they weren't helping. And I know for a fact that is not at all what Dave and Chad did. So you guys are really, really lucky where you are. Reach out to them with help. And believe me, LPL Research is a 30-person research team that does a lot of stuff. And we are here as well. If there's anything you need, just ask Dave or Chad. I would love to help. But you guys are in good hands. And here's to beating COVID soon, an election that comes off without a hitch. Whatever that means, I don't even know anymore, but an economic expansion. And I'm a Bengals fan. So here's to the Bengals with Joe Burrow winning a few games. I could use some of that. He's looking pretty good. You just got to keep him upright. That's the key. Keep him upright. But he looks like the real deal. So
that's true.
Yeah,
Well,
guys, thanks for having me. This was fun.
We have our own problems with the Vikings, but thank you for joining us. Dave, do you have any thoughts to wrap this up?
Yeah, I just want to say, I just appreciate everybody for tuning in and watching this. And Chad and I and my whole team here are very happy to help any way we can, any of your questions. And I want to really reach out, Ryan, and thank you for taking the time to do this call. Just really fantastic to help support our business and our clients. And I just want to thank everybody. And Chad, great job. Chad put this together and all the technology with his Zoom business. So thanks, everyone. And I know that we'll be seeing everybody soon.
All right. Thanks.
Thank you.